All right, welcome to Talk Tickers. Today, we're diving into the Q4 earnings for Simulations Plus, ticker SLP. Now, on the surface, the numbers look pretty weak, but the stock absolutely shot up over 14%. So, what exactly did the market see that maybe we didn't? Let's get into it.
Yeah, you're seeing that right. The day after their earnings call, the stock just ripped higher by over 14%, and on some pretty heavy volume, too. Now, a move like that usually signals a massive beat and raise quarter. But, spoiler alert, that is not what happened here. Not at all.
In fact, the headline numbers were, kind of ugly. Revenue was actually down year over year. Adjusted earnings per share got cut almost in half, and they even posted a GAAP net loss. So what gives? What did the market see that wasn't obvious on the surface? That is the big question we're going to answer right now.
To really understand this rally, we've got to unpack the story that management told on the call. It's a story about hitting the reset button, about an AI-powered future, and, most importantly, about a stable outlook. Okay, first things first. Let's look at the actual numbers that caused all the initial confusion. The fourth quarter results were, to put it mildly, pretty mixed.
So the contrast on this slide is what's so fascinating. Revenue came in at $17.5 million, and adjusted earnings per share were 10 cents. Both of those were perfectly in line with what Wall Street was expecting. But look at that year-over-year column. Revenue fell 6%, and adjusted EPS got hammered, down 44%. So the takeaway is this. They met expectations, but only because those expectations were already pretty low to begin with. The business itself was definitely showing weakness.
And if we dig just a layer deeper, you can see the weakness was pretty much everywhere. The software segment, that's their higher margin business, saw revenue drop 9%, and the services side also fell by 3%. So this wasn't some one-off problem. That tough macro environment for pharma and biotech was really hitting them across the board.
So if the numbers were that weak, investors must have been buying something else, and that something else was the story. Management came to this call with a really powerful narrative about resetting the business and pivoting to a whole new AI-driven strategy.
The centerpiece of this big reset was a massive $77 million non-cash impairment charge for the full fiscal year. This was basically them writing down the value of a past acquisition. Now, a huge write-down like this is never great news, but it let management frame 2025 as the year they cleared the decks, creating a much cleaner slate for 2026. Think of it like they took all their medicine at once, so future results won't be dragged down by old mistakes.
Then came part two of the story. The future. The CEO, Sean Common, laid out this vision where Simulations Plus is no longer just selling individual software tools. Instead, they're aiming to become the essential integrated platform, kind of like the entire operating system, the very backbone for all of pharmaceutical R&D.
And this slide right here perfectly illustrates their new playbook. It's a three-step strategy. First, you start with their core strength, science that regulators already trust. Step 2, you connect all of that in the cloud. And then, the final step, you layer on AI to basically supercharge the entire process. This is way more than just a new product, it's a story designed to put them right at the center of the whole AI and pharma revolution.
But look, a good story isn't enough, right? Investors needed proof. And they got it in what is always the most important part of any earnings call, the forward guidance.
Okay, this slide is the key. This explains the entire stock pop. Management was pretty cautious about the very near term, guiding the first quarter revenue to be down 3 to 5%. But, and this is the part that changed everything, they reaffirmed their full-year guidance for $79 to $82 million. For a market that was terrified of a guidance cut, just holding the line was a massive, massive sign of confidence and stability.
And here's the data that backed all that confidence up. The company's services backlog, which is basically just contracted future revenue, grew a really strong 28% year over year. You can think of this backlog as guaranteed money that's already in the bank for future quarters. It makes their promise to hit those full-year numbers way more believable. It completely de-risks that guidance. Okay, so let's put this all together. What is our actual thesis here? Based on everything we heard on this call, here's how we see the stock playing out from here.
So our view is that fiscal 2025 was that painful but absolutely necessary reset year. That big impairment charge, it's in the rearview mirror now. Looking ahead, that full year 2026 guidance feels pretty conservative, and it's achievable, which creates a nice, stable floor for the stock.
That strong backlog gives them a buffer, and this whole pivot to an AI ecosystem, while that offers some real long-term upside, especially if they can start charging more for these new capabilities.
So based on all that, we're assigning an outperform rating. The market rewarded the company for setting a low bar and giving a stable outlook. With the story now shifting from cleanup to actual growth, we think this stock has more room to run.
So, the trade idea? It's all about playing the next big catalyst, their virtual Investor Day on January 21st. The trade would be to buy call options, which is basically a bet the stock will rise heading into that event. We're speculating they're going to unveil a really compelling AI monetization strategy that could be the spark for the next leg higher.
And of course, as always, please remember, this is not financial advice.